Our next session is titled Portfolios for the Future, the New Normal is Here. To moderate this session, we have Aditya Narayan among us. Aditya has 25 years of experience in equity markets. He is the head of equity research at Edelweiss and the India Equity Strategist. In his previous role at global financial institutions, he has been a banking and financial analyst, India Equity Strategist, and head of research. Ladies and gentlemen, please put your hand together to welcome Aditya Narayan.
Thank you. It's difficult getting following on an act like the previous one, which looks at technologies, which looks at financials top down, and looks at so many issues that are varied from whether it is Brexit, whether what is happening in the financial sector, or developments in the future. This one's a little bit more specific, and it's a little bit more grounded in terms of what we actually do, which is portfolios for the future. The new normal is here. Now, we keep hearing a lot of talk about this is the new normal and that is the new normal, but I would tend to believe as far as the investing world is concerned, this is actually the new normal. It is something that has gained phenomenal traction in global markets. It accounts for a large part of global funds. It is something that is at a very incipient stage as far as India is concerned, but I can assure you it's something that's going to make a difference to your portfolios, to your investments, and to the way you think about equities. To talk about it, first in the form of a presentation of about 35-40 minutes, and then to take you through Q&A for about 15 to 20 minutes, we have with us Virginie Maisonneuve. Now I have to say, I'm having a little bit of a trouble bringing up her resume on my iPad, but here it is. Virginie Maisonneuve is a member of the CFA Institute Future of Finance Council. Previously, she served as the Chief Investment Officer at Eastspring Investments. Virginie has over 30 years of experience in the industry. She served in various positions globally for such companies as PIMCO, Schroders, Clay Finlay, Battery March, State Street Research, and Martin Currie. Virginie started her career in China as a consultant for the Ministry of Foreign Affairs while attending political economy classes at the People's University there. She's a global media commentator, is regularly interviewed by Bloomberg, CNBC, and the BBC, and is a thought leader on global markets, sustainability, diversity, and creative disruption in the asset management industry. Virginie has been named as one of the top women in finance in Europe, one of Money Management's executives' top management and asset management, and one of Investment Week's highly commended International Investment Women of the Year. So with that, I bring on Virginie.
Hello, and thank you for being here today. I know I'm the last thing between you and your lunch, so hopefully you've had enough snacks so you can stay with me for a full hour. I've got a presentation that has a fair amount of slides. I think you'll be able to get the slides separately if you want to. There's a lot of data. But I want to say how impressed I am with CFA India. I first invested in India in the early 90s when we had to physically carry our stock certificate when I was at Battery March with one of the first foreign investment funds. And things have changed so much. I think clearly CFA has been able to gather this fantastic group. The other thing that I'm really proud of is to be part of the CFA Future of Finance Council. And one of the things that I think is really important that you may not know is that we've been able to push for sustainability, which clearly a big part is climate change, to be included in the CFA program and module for the UK. I'm not sure if it's here, part of the exam yet, but that's really important to me. So just wanted to say a few remarks. And of course, as you've mentioned, the new normal for me clearly includes climate change and ESG, and we'll talk about that. What I'm going to do today is not tell you how to do ESG for your portfolios, but try to explain why, as an investor, I've always been an ESG investor, and I've been in the markets for about 33 years, and why I think the trends that I call the shapers, those long-term trends that really shape the environment that companies and governments evolve in, are pointing to a direction where the asset management industry cannot not be ESG or giving ESG options to our clients. And I hope that you'll appreciate that once we go through this presentation. So just a few, it works, which is fantastic. A cloud map with some of the things that we will cover. And essentially, I would like to, oops, sorry, I went back. I'd like to talk a little bit about the purpose of asset management to start with. So our job, going back to basics, is we have clients who want a service, they want a certain amount of return with a certain amount of risk, and they expect us to deliver. We need to have their trust, which is being professional, being ethical, have a clear process that we can explain, and basically show we have an edge in extracting alpha. And the reason why I'd like to go back to that is many active investors in the past, really 10 years, have not been able to demonstrate that added value. And this is partially why ETFs has been really so strong in growing. Sorry, let me go back here. So $4 trillion of ETF today, as you know, a lot of fee pressure. My understanding is ETFs are really coming now in India, and you've seen the movements across the world. Rates are here to stay low, I believe in the lower for longer. Regulation is getting tighter in our industry. Now, not only for regular asset management, if you want issues, but if you think of TCFD in the UK, if you think of a lot of stock exchanges asking in terms of ESG and sustainability disclosure from companies, even in countries like Indonesia, where 30% of the market on the equity side is coal and plantation, this is putting a lot of pressure on our industry. I think another side of the pressure will come from artificial intelligence, which is one of the topics that I'll highlight during this presentation. And that will allow for mass customization, which means that our clients, individual and institutional, are going to be much more demanding. And that's going to also be part of the new normal. We're going to have to be tailoring portfolios. And if you're not on the AI or the robo bandwagon, it's going to be very, very difficult to offer that as a service. And the disruption in industry around that is going to be very, very large. So what I'd like to do today is talk about another source of disruption, which is what I call the shapers. And the shapers are long-term trends that generally have tipping points. But they're very hard to estimate when that tipping point is. So I remember talking about China again in the early 90s in New York. And I had people asking me if I was a communist and why was I talking about China. I've talked about climate change for many years as well. And I have to say, normally I get a lot of eyebrow raising and a little bit of condescendence and a little bit of skepticism, or a lot of skepticism. And in the last 2 or 3 years, things have changed. And we'll talk about why, because this is really important. So the themes I want to touch on are those. Now, to be honest, we could spend a whole day discussing them. So it might be frustrating if in some areas I go a little bit faster, but I'm happy to take questions afterwards. So it goes this way. The combination of trends such as demographics, climate change, technology, and now AI, as well as the shift in economic power really coming from the growth of emerging market, taking share of global GDP, if you want, are creating a new paradigm. The issue we have is that growth, that global growth since the Second World War has been very carbon intensive. And so although Asia will remain at the core of the growth that we'll see for the next decades to come, the model in Asia needs to change because that model of growth is not sustainable. Actually, the whole model globally is not sustainable. But in order for Asia to enable that growth, we need to see changes in models. The other key trend, of course, is as a result, ESG has become more mainstream. ESG today is 30 trillion of assets. So I've always invested on an ESG basis because I was looking for sustainable growth in companies. At that time, the terms didn't exist, and it was basically zero of assets. If you look at the UNPRI signatory now, it's about 80 trillion of assets. So this is something, as it was mentioned in the introduction, that is absolutely phenomenal, and that I have no doubt will come here to India. So looking at the survey that CFA has done, interestingly, 73% of leaders believe that ESG is important and will grow in terms of important. 70% believe that India will become more influential, but only 11% believe that our industry has a positive impact on society. Let me talk to you first about demographics. Why demographics? Demographics is the economic, basically, tissue that we work on. Humans work, they gather assets, they spend that assets, and as investors, we need to understand that first base, if you want. How populations are built, how they're structured is very important to see what we have. And there, clearly you go staggering growth from 2.5 billion people on the planet in 1950 going to 11 billion and peak, hopefully, by 2050. Now, when we talk about climate change, we can wonder if that's going to happen, but those are the current forecasts. And they're the current forecasts based on the structures that we have. So even if fertility was dropping dramatically, you'd probably still have that trajectory until 2100. Longevity is increasing, so of course in terms of services, particularly for the financial industry, that's really important. Aging is happening very fast. Fertility is declining everywhere. Middle class is growing, and this is where Asia is taking the market share, getting to 65% market share from 46%, and that middle class is growing by 78% between now and 2030. Clearly, the role of China and India growing even bigger. And the one segment of the population that's very important to understand is the millennials. Because the millennials are getting to that peak spending bracket. So the way the millennials spend, the way they think, what they like, what they don't like, has a big impact on all sectors. And we'll talk a little bit about that in the size. You can see 75% by 2030 in the US will be millennials in terms of the workforce. Just a little bit of ranking. You can see that by 2050, India will be the largest country in the world, taking over China in 2027. But what's really interesting to me is Nigeria, because when you see the role of Africa in that population growth, you can see that the population in sub-Saharan Africa will nearly double by 2050. Unfortunately, climate change is also hitting Africa extremely badly. So we'll talk about population displacement, which is going to be a big issue over the next few decades. On the other hand, countries like Japan and Europe are seeing shrinking population. India is about to reap a large demographic dividend, as you can see on the chart on the right-hand side. Sorry, right here. Preparing for that demographic dividend also means that we are preparing for a sustainable growth path. Otherwise, it could become a hindrance rather than a dividend. So looking at pictures, aging in pictures, this is the dark areas show population over 65, and you can see how this is changing very rapidly from 1990 to 2019 to 2050. Why is this important? Financing, pension gap, infrastructure, disease. Taking care of older population is a very different thing than taking care of younger population. And when you have a lot of disruption happening, geographical disruption or displacement, it's going to be front page media. It's going to be really, really important for governments to think about it. And of course, bond issuers, part of it will be financed by bond issues. So moving on, a little bit talking about the millennials. They're born after 1980. They're reaching their peak. They're mostly in emerging markets. They are being taken over very soon by, or they are in terms of number, by Generation Z, which thinks a little bit differently. But actually, what's really important is they have the current spending. They believe in the sharing economy. Their environmental issues are very important to them. They believe in well-being, and they are very digitally savvy. They will request the ESG products. Basically, if you look at that, they will request platforms with technology and AI. So again, for us in terms of asset management and our new normal, that is very, very important. China has more millennials than the whole population in the US, so this is, again, from an investment standpoint, very important. And something that often people don't think about is the soft factors. Trust is a big issue for that generation. So you can see here, 27% of millennials do not believe that media is giving them accurate information, and 45% of them believe that their political leaders are not giving them accurate information. 49% believe that technology can help them, but a large part of them, and it goes back to this balance of work-life, right, would prefer to work in the gig economy. And what we call the gig economy is really more independence, more solo consulting and things like that, which is very important if you believe in the sharing economy. Demand for cars, demand for properties, et cetera, that will have a big impact. In India in particular, millennials have a huge impact, 50% of the workforce. Female millennials in India are very ambitious. Index 87.4 versus 86.2 for their male counterpart. They're very big on savings, very big on insurance product, and they want to manage their own finance. Again, believe in the sharing economy. So for us, in asset management, this is really important. This was one of the first trends. That sort of sets the basis. I'd like to talk now about the technology trend. So technology, as I like to say, my summary there is BNW is AI plus HI plus EI. What do I mean by that? Brave New World is artificial intelligence plus human intelligence plus emotional intelligence. And not many people talk about emotional intelligence. And clearly, what is happening is with accelerating pace of technology development, cost of computing power coming down, and the cloud, we are now in a place like we've never been before to include AI and technology in all industries. It allows humans to think faster and better. In asset management, we've been quite dinosaurish. We've not changed that much. Operations has changed. Asset management, front office has not really changed. And my suggestion is this is going to happen very soon. AI will also be able to help us with ESG. So what we need to do in light of this advance in technology is help our portfolio managers. Help them develop soft skills. You can learn emotional intelligence. Help them think about using data, unstructured and structured, develop new toolbox, use predictive analysis. And believe me, it's actually even with little resources, if you put together people who are working on a T-shape level, so who can work across the industry or across different disciplines, you can achieve a lot. The issues, I believe, is a lot of our industry is very siloed. And this is the issue. Quantamental, so the blend of quantitative and fundamental will continue to evolve. And I believe trading efficiency will evolve, which will mean more fee pressure. And biometrics and neuroscience will also be quite important. So how can you basically bring your skill set in your firm to the level of navigating that disruption? You need to build T-shapes. T-shapes is where a vertical bar of your T is the technical skills that your teams have, and the horizontal bar is the ability to work across discipline. The reason for that is this is, in my view, the only way you can really work and adapt and benefit from the disruption. Leadership skills are very important. I would suggest that board and executive committees are going to look quite different in 10 years, given the trends and how disruption is going to come, than they've been in the last 10 years. Now I'm getting to the part that is a little bit more controversial. And as investors, we not only need to see the trends, so the base, like demographics, the disruption from technology, which will put us at odds with competition. Some of the competition might even be technology companies or other companies. But also we need to analyze the resources that the governments or the companies that we invest in have. And the ultimate resources clearly is our planet. And I would think that, as I say, I've got a lot of eyebrow raising. A lot of people do not believe in it. And the climate change issue is a very big issue. And the reason why a lot of people don't believe in it is there is a lot of science behind it, but there's a lot of art as well. It's also a very difficult issue to deal with because it's a global problem, but not everybody can pay the same to actually solve the problem. So the carbon emitted in China has an impact on India, the US, Europe, et cetera. How do you price that? It's very difficult. But we're getting to the level, the other thing that makes it very difficult is we deal with political cycles that are short in nature, 4 years, 5 years. But climate change is a very long-term theme. And long-term themes are very difficult for humans, particularly when they're longer than 10 years. It's very difficult for humans to incorporate in their decision-making and in their basically planning. So I've always thought that we would need a grassroots movement to really move things forward, and I think we're there. I think we're at the beginning of very powerful grassroots movements. So you can see all the marches and protests that you have now, but you can see how Greta Thunberg, and I was trying to put a part of her interviews or speech, but I think now that everybody knows about her, you can Google her, and I would really invite you, if you have not listened to her talk, to listen to her. She is Scandinavian, she's only 16 years old, she has Asperger, and she has taken this as her mission. And she's talked to the United Nations, she's talked to the US Senate. Really, it's worth listening to her. She's just been elected as the Person of the Year by the Times. And I think it's a reflection of what she represents. What she says is, you are stealing us from our future. And climate change is an issue that is so long in nature and that has so many feedback loops that it locks in the problems. And this is what she means. And for a 16-year-old, not having a future is clearly very dramatic. She's had the courage to take it forward. We could talk about the topic for a long time, but it is it is something that we want to highlight. I'm going to have a lot of numbers in there, and you might have other source of data. The reality is we're on a path. So from this grassroots movement, what you are seeing now, really in the past 3-4 years, is more CEOs of companies stepping in. We're seeing an answer from the corporate world. And here, this is just a quote from the CEO of Unilever in the UK, saying that climate change is the biggest threat to humanity that's ever been. What is climate change then? Some very famous or very important political leaders believe that it's a hoax, and we know who I'm talking about. So I've decided to go back to basics. Climate change is a significant change in average temperature over several decades. So it's not a blip on the map. It is observations that thousands of scientists are putting together. And I'll show some of the charts. It is measured by many different stations around the world, satellites, oceans, land. And it is also using science now to look using ice and tree rings at temperatures back in time. Because clearly when we can measure temperatures today, but when we say it has grown by X over the past X thousand years, you need to have a meaningful way to measure temperatures historically. The process of warming and climate change is really easy to understand. So you basically have the sun that we need coming on Earth, and the energy, the heat from the sun is reflected back in the universe, if you want, with ice and clouds. And you have carbon sinks that are oceans and trees who absorb carbon. The issue that we have is the intensification and the growth of CO2 in the atmosphere has been such that we have a greenhouse effect, we've heard about that, where we cannot facilitate that heat exchange, if you want, with the outside or the universe out there. This is the problem. So the problem is that creates a lot of chain reactions and feedback loops that are very difficult to break. And climate change is a cumulative process. So the carbon that is today contributing to heat and warming was probably emitted 10 or 15 years ago. So because this is a super tanker, it's not an easy problem for governments to deal with. In terms of the carbon sinks of ocean and trees, it's been very, very difficult for them to follow. So the ocean in the past 50 years has taken in 80 to 90% of heat absorption, but now much less. And the ocean is becoming much more acidic, which has a lot of other impacts that we'll talk about. So a lot of people will say 1% is not a lot. 1%. And this is why I put the 5%. Okay, 5%, 5 degrees is the only thing that separates us from the ice age. At the peak of the ice age, the ocean levels were 106 meters, and you can check the numbers. I checked it many times because I thought that was way too large. 106 meters lower than the current oceans. This is what the issue is, right? And so it is a delicate balance. Here, just a chart to explain how things are, put a picture on this. Very delicate balance and a very fragile equilibrium. What is the impact? Again, trying to keep it very simple. When the Earth's atmosphere heats up, you have changing weather patterns, right? So put it simply, floods become much bigger, heat waves become much larger, storms are much more intense and stay much longer, et cetera, et cetera. Fires are much stronger. You've seen the Australian fires, you've seen the Californian fires, so everything is magnified. Droughts. The ocean, the ability for the ocean to absorb, as we've discussed, is limited. The rate of warming of the ocean has doubled since 1993. Now, the reason why this is important is the warming and the acidification is not only having a huge impact on life in the ocean, but on coral. And coral reefs are about a quarter of food for all life in the ocean, which of course in turn we use to provide food for us, but also absorbing more energy. So you can see how the feedback loop is working here. Temperatures overall are increasing at an accelerating pace, and concentration of CO2 is at the highest in terms of part per millions as we measure it. What is the impact? Again, this is a very high level. Impact is, number one, glaciers melting. Glaciers melting feed to ocean sea level rising, but also potentially to no more ice on the Arctic. And below the Arctic, you have what is called the permafrost that is hosting 1.8 trillion tons of CO2, of carbon. If those are released in the atmosphere, it's not 1 or 2 degrees that we're talking about, is much more. I remember COP21 is trying to limit the increase in temperature to 1.5 degrees. Of course, security, so crop yield, estimation is that 1 degree in temperature increase corresponds to a 10% drop in crop yield. Of course, all of those are estimates. Population displacement, so some of the forecasts are that at 4 to 5 degrees, about 1 billion people would have to be displaced. This is bigger than the population that we had at the end of the 19th century. If you think that the displacement of people in Syria, which now people are linking to also climate change, because there was issues with desertification and heat, and if you see how that is linked with Brexit and some of the other election results that we've had in Europe, think about what 1 billion people being displaced would mean, right? Of course, as investors, we have to think about that because the ecosystem, again, thinking about the new normal, the ecosystem will need to adjust dramatically. Now, of course, then you look at shelter infrastructure, the internet infrastructure. A big part of the internet infrastructure is underwater. So the cost of reinforcing this infrastructure, if that is needed, would be tremendous. And of course, property. So just one study here, and you have the source if you want to go and check it. In the US alone, by 2100, estimation of coastal properties that would be underwater would be above, 400 billion, so $500 billion. Energy grids would be disrupted. And of course, productivity goes down dramatically when heat goes up. So the current system, as we know it, would change. This is just a picture to show the red part is the ocean where temperatures are above 32 degrees Celsius. That's a picture of the trends, so it is not a blip. This is increase in temperatures and clearly leading to increase in water level. So why? Clearly, we've all lived through that fantastic economic growth that we've had since really the last World War. The problem is this model is very carbon intensive. So I hope you can see, well, the blue charts are basically showing the emission of CO2 in gigatons, and you can see how oil and coal have been the major fuel and contributor to CO2. On the country level, China is red, the US is orange, and Asia Pacific is the lighter orange. So it's completely linked. So it's not about blaming, but we need to know who emits what to try to do something and which sectors. China is currently the largest emitter, but the US leads both on a per capita and a cumulative basis. In terms of largest, China is 27% of emissions currently. India has grown dramatically, but of course has committed to a very large program in renewable. China also emissions should peak around 2030. When we talk about COP21, you'll see that we may not have until 2050 to really take meaningful action. Russia has done nothing. Actually, when we talk about the disparate impact of climate change, Russia benefits in a way, the same way Canada does. And why? If you think of them as isolated countries, because they're losing ice. If you lose ice, you can plant more crops. But that impact, of course, is bad for the overall, again, it's a holistic, the overall planet, right? The US has increased emission in 2018 thanks to some of the measures that were taken or reversed recently. And the EU actually collectively has declined by 20% since 1990. If the US could adopt the CO2 intensity that Europe has, it would lower its carbon emissions by 50%. You'd think that's not that hard, right? There has to be ways where we can do that. Looking at it on a transport basis, it's really our mode of life. If you look at electricity, transport, agriculture, deforestation is 20% of carbon contribution, and industry. Clearly, it means a radical shift on how we live. This is a very important chart. This is saying that why is everybody thinking the 1.5 degrees? Well, because beyond 1.5 degrees increase, there's a lot of things that are happening at an accelerating pace. But to keep to 1.5 degrees by 2050, we need to have zero net emissions. And that's going to be very difficult to do. At the current rate of emissions, the forecast is that we will increase temperature by 4 degrees. The best forecast is that the ocean level would increase by 1 to 3 meters. If you add the effect of floods, it could be as much as 6 meters. So between 1.5 and 2 degrees, what's really the big deal? It seems like it's very small. Well, it's an increase of 33%. And here, the main one is the Arctic melting. But you can see, for example, we're not going to go through all the data, we would not be able to plant wheat anymore. We'd have to plant wheat only in special farms, vertical farms or climate control farms. Water, fresh water, availability, and some of the impact at 2 degrees are really irreversible. The impact on the economy is also what's really important to understand. The countries that are most at risk are the warm countries, the countries basically in the mid-latitude levels, and the emerging markets. A 2-degree increase means that a 4-degree increase in highest temperature could take place. It would mean that the problems we had in India in 2015 could happen every year in terms of heat waves. It's very significant. Economic impact, India, Russia, and China would be the most, from a GDP standpoint, hurt. Although, as we said, in the case of Russia, there'd be some arable land that would come. Keeping it to 1.5 degrees is basically saving the loss of $12 trillion. Just remember, Hurricane Dorian took 25% of GDP of the Bahamas in one day. Asia is particularly touched by climate change. That's why I said there is no doubt in my mind that all portfolios will need to be ESG compliant because of this in Asia and on a global basis. The reason why Asia is most touched is 70% of coastal population in the world lives in 8 countries in Asia. You don't need to see water rising by 6 meters to understand what that does. Think here, think Singapore, think Paris, think Shanghai, think New York. So we're going to have a lot of displacement. Actually, currently, a lot of countries are planning to increase their coastal population, mostly because of urbanization. Water supply shrinking clearly is also a big issue. India is going to hurt. Flooding, and here there's melting glacier and monsoon pattern flooding, very important. And the largest source of emissions is coal, agriculture, and cattle. 15% of the world's cattle, which emits methane, is in India. The commitment to reduce emission is fantastic, and there's a lot of work to do, a lot of investments that I think will lead to good outcome from an investment standpoint, but that needs to be carried on. So what are countries doing? This data is not confidential. You can find this data everywhere. The top 5 emitters are not doing anything. They're not committed to that 2050 zero net carbon emission. The corporate sector is waking up. There's a lot of actions, and the grassroots movement is coming up. This is a picture that I think is very interesting. A lot of countries at COP21 said they had ambitions. In terms of having a policy framework targeting net zero emission, there's only 7 countries who have such a plan. They're mostly Scandinavian countries. Corporate action, corporate discussions, a lot of people are getting organized. A concept for us as investors that's very important is the concept of shareholders versus stakeholders. Why? Shareholders, when we invest in a company, shareholders' return is quite easy to find, right? We look at profits. Stakeholders' returns is very difficult. And stakeholders' returns will be employee benefits as well as impact on society. How do you measure this? This will become a very important way of measuring success, I think, in asset management. When we combine all those trends, what does that mean? It's about rising ESG. Again, I'm not bringing it to a society level here. I'm just bringing it back to our industry and why I believe the new normal will be ESG. It's a first-of-a-kind challenge. You are seeing a slow but definite response. If you look at regulators, if you look at TCFD, for example, stock exchanges, and I'll talk more about that tomorrow for those who are coming tomorrow. Political models will need to adjust. We need much more collaboration, and we are actually seeing a fragmentation of ecosystems around the world. If you see the language that Mr. President Trump is using versus other leaders, for example. And we need a new paradigm. We probably need lower growth, more sustainable growth, and more financial inclusions and population inclusions into this. For us, analyzing the competitive landscape is going to be very important, assessing risk. Our clients will increasingly be millennials. Consultants and clients will ask to see the carbon footprint of your portfolio. I've done a lot of work on that. It's quite tricky. But I think the same way you need to show the PE of your funds, the tracking error of your funds, the number of stocks, you'll be asked to show the carbon footprint of your portfolio to be able to distribute or to sell, and your clients are going to ask for it. I think we'll be able to use artificial intelligence and technology to help us deal with climate change and to help us deal with this measurement issue in portfolios and finding the right opportunities, establishing best competitive edge, new opportunities, particularly in green finance or mitigation and adaptation. This problem is for all asset classes. If you've watched what green bond emissions or issues have been, you'll see that it's growing dramatically. And I really believe that there's going to be a difference in pricing. People who will issue green bonds to finance green projects will be able to get finance at a much lower cost. On the other hand, even if you're a municipal government in a flood area and you try to borrow to do infrastructure work, you're going to have to pay a much higher cost just because the expected return is going to be impacted. I truly believe that most benchmarks will be ESG compliant. I know Morgan Stanley, I've done a lot of discussions with them. I think ESG benchmarks will be the norm. And Morgan Stanley, for example, and other providers have such benchmarks. This is just, I want to leave time for questions, so I'll move on from that. How can you put it in your portfolios? Integration, so from the bottom up, I think that's the best way. A lot of people are doing screening, negative screening. So a lot of insurance companies now are not doing tobacco, they're not doing oil, fossil fuels. Or you can do positive screening. finding sustainable growth through companies who are doing the right thing. That goes through a lot of research and training your teams to make sure that they ask the right questions and they model the right thing. Collaborative approach in terms of measuring, I think we're in the depths of such a problem that working with your colleagues and working with firms, establishing standards together, I think is the way forward. Public-private, so working with public institutions particularly in private equity, for example, I think that's another way to really try to influence the debate. And people who say that ESG does not lead to performance, that is not correct. If you look at the benchmark of MSCI ACWE performance versus MSCI just world, you will see an enormous gap. So ESG has a big impact, particularly in emerging markets. And it comes from the drawdown. So the study that Morgan Stanley has done is that if you have the worst ESG ranked stocks, the bottom 20% basically have 3 times more large drawdowns than the top ones. So there's very clearly, and I think that hedge in performance will continue to increase. Here, it doesn't mean you have to just buy solar panel. You have to think of the themes and see where you can find opportunity. We talked about food. We talked about crop. We talked about shelters. We talked about property. We talk a lot about a lot of things. It's as much about not being in the wrong stocks or wrong bonds as much as being in the right one. And don't forget the technology theme as well in terms of sharing and entertainment. So tipping points, and that's where I want to finish. Tipping points are very hard to forecast, but they're like geopolitical events. Geopolitical events will continue to happen, and the tipping points in either when ESG is massively adopted in a particular area, or when climate change becomes such a grassroots issue that it forces governments to take action, or when AI and technology tools become so available that other sectors come into our industry. This is very hard to forecast. But what you know is this is going to happen. And so it's about, again, training your teams, thinking about all those things in the portfolios to make sure that you are ready for ESG to become mainstream. So I think I'm going to stop here and take some questions. Yeah, thank you.
Thank you, Virginie. That really did have a lot of color that investors typically don't look at. I've got a bunch of questions, and maybe I'll start off with one which I think has played for a while on portfolio managers' minds, which is the significant growth of passive investing or ETF investing. Do you see ESG investing as a kind of a bulwark against that trend which is sweeping across the landscape, particularly global, but I suspect it's going to come to India sooner rather than later?
I think that's a very important part. So I think it will. The cost of standard ETFs is coming down dramatically, and it will for the reasons that many active managers have not performed.
Right.
However, ESG provides you, if you can add value through ESG, and my conviction is very high that you can, by finding the right companies, the companies who grow sustainably, et cetera, you will be able to outperform. The other thing is I think we'll see an enormous trend over the next 5 years in ESG ETF.
Okay.
Where you'll price that at a lower price but still higher than the standard ETFs. I think that's a huge growth areas.
Right. Okay. When you look at ESG investing, is it a kind of a holistic ESG score that you take, or do you split it up into E and S and G? And I ask this particularly in the context in India where G has been a massive issue for the market. You've had a lot of blow-ups. There's a huge valuation differential between companies that seem to show decent governance and others. So in your investing thinking or your prognosis, is this something that you can split up, or you need to look at it as a whole, or it's somewhere in between?
To me, you can't do the average. You need everything.
Right.
You're not absolute.
Right.
So it doesn't mean you can't buy coal, for example. It means that if you buy coal, and particularly if you sign your NPRI, you need to be engaged. You need to influence the company, and you need to understand. That's where the EI, the emotional intelligence, and that soft skills of connecting with companies is going to become more and more important to understand that they will really do something. Because actually, one of the biggest impact, if we can have the bad guys
Right.
Be much less CO2 emitting, we have a
Right.
much bigger impact.
Right.
Right? So I think, but you need to have the confidence that they have that ambition in terms of governance,
Right.
that clearly the social aspect on how they treat employees and communities is there, and that they understand their environmental issues. Okay. So I think it's the three of them.
One of the things that I think businesses think about, whether rightly or wrongly is separate, but there is a relatively high cost involved in trying to move up the ESG score, right? Whether it is on the social side, whether it's on the governance side, and clearly on the environmental side. Now, is this something that there is a big pushback from businesses, firstly? Secondly, one can argue that this will put a disproportionate burden on smaller companies and smaller businesses. So what does it mean for investing in small caps and mid caps? And I've got a specific question saying, ESG is nice, but isn't it very costly? And is it something that's going to be a drag on smaller companies?
So yes, the reason I agree. So let me start with the reason why did I spend so much time instead of talking to you about how we can do ESG in portfolios? Why did I spend so much time talking about those dramatic events? It's because, again, I think if you don't know the background, it's very easy to say, that's not important. So if you believe that we are close to a tipping point, say in the next 10 years, do you really want to buy companies who won't be able to survive? Or who are going to be taxed massively for other reasons,
right.
Carbon tax or whatever? Do you want that? Do you want to be in unsustainable models? I have invested in very small companies who ended up being taken over. Think about Tenberg, right? Video conferencing by large companies because they were providing solutions that were helping with the problems. And I really believe that the challenges that we have, that disruption is going to bring a lot of opportunity in alternatives, so private equity, VC, and also small cap.
Right.
So the next stage of companies who will find products or innovative ways of creating more sustainability and will be taken over. So I think, yes, you can find them in small cap. They just have to be geared towards the right business model.
Right, right. Now, there would be, as a theme, ESG has gained a lot of momentum globally. Clearly, the assets under ESG management have been growing very dramatically. But there is also a cynical view that this is more marketing. It's a way to sell your funds to raise more money than something that is genuinely based at either good or a different approach to investing. I mean, what would be your thoughts on that?
So my view is if you do what we call greenwashing, which is marketing ESG, you will be found. And it's really interesting to see every quarter the UNPRI, so UNPRI is United Nations Principle for Responsible Investment. When you sign UNPRI, you commit to a certain level of reporting and integrity around this, of process. And there's been quite a few firms, and I don't want to name anybody, who had signed and who've been accused of greenwashing have been kicked out of UNPRI. And when you get kicked out of UNPRI, you're front page of the FT, and they show that you have been basically abusing the label. I think consultants will increasingly also look at that. So for the reasons that we've discussed, this is very serious. You have to do it. It doesn't mean you do it immediately for all portfolios.
Right.
Right? But yeah, if you do it, you have to do it properly.
Okay. One of there is a lot of money under management globally under ESG. But one of the trends is that Europe is the one where you have the maximum amount. I think half of European assets are under ESG in some form or the other. And the US is growing rapidly. But the reality also is that the areas that require the greatest amount of focus on ESG are Asia and India and China in particular. And their local markets have hardly seen any real money being raised. Navneet has been at the forefront of raising and bringing to the fore the entire ESG investing theme, but you've not had so much of a pickup, or absolute amounts are low. Your sense, since you've followed this form of investing globally over an extended period of time, what is the kind of S-curve or hockey stick curve that that you would expect in terms of money coming under ESG?
I think it's going to be growing rapidly because people will connect. So again, it will be easier to do because you'll have more technology and AI.
Right.
Okay, AI helps you to get through data and find information that you could not before. It will be in demand because millennials will demand it. And this is why we went through the demographic aspect. And it will be in demand because you'll have more floods, more drought, more front page newspaper, and people will see it. And ultimately, I truly believe that the companies who are not ESG or sustainable will go bankrupt.
Okay.
Now, it won't happen tomorrow.
Right.
So I really think it's a global trend. It doesn't have to, look at China. Okay, China is the largest emitter.
Right.
And I, was one of the first investors in China. I have visited the environmental agencies in China for many, many years. And you went from, we have to grow at any cost, to we have those environmental agencies, we know what they're saying, we can't implement it, to policy being put in place, to now a target peak of 2030.
Right.
It's a long time. It's probably too long.
Right.
But there is a path. Once you have a path, it's easier to accelerate it.
Right.
Right? You need to have that path. So basically, you need to have the policy framework. You need to have the demand from the clients, which I believe you will have, because it will lead to superior performance. And you need to have the grassroots movement.
Okay. And just the last specific question would be, what is your sense of how Indian businesses have responded to this or taken up on this entire ESG issue?
I think people, if there's if there's more discussion around it, I do not know anybody. So let me answer this way. We're all human beings before we're business people.
Okay.
Right? And so we all family members one way or the other, and we all global citizens one way or the other. And so I believe that everybody, once people know the information and the data, is taking this seriously and will want to apply that in their business at some point in time.
Actually, on that note, I think India probably needs to take it more seriously, because you've had huge challenges on the environment side.
Yes.
As you said, you'd rather be in Bombay than in Delhi on this trip of yours. Whether it's the social side, you've had demonstrations aplenty in the recent past, and governance, I talked about businesses that have blown up in India over the last year or two. So before I say thank you and before I ask you to join us for lunch, your thoughts on 2 books that you've read recently that you enjoyed and something that you would recommend to the audience.
Thank you. So I'm usually asked about investment book, and I never give investment books. And it goes back to the T-shape. There's 2 books that I think you should read. One is a mindset book. It's called Mindset by Carol Dweck. Mindset and attitude and behavior is what's going to help us get out of this tremendous issue. The second one is a book called The Uninhabitable Earth by David Wallace Wells. It is a lot of the information that he uses, I've used in my presentation. He's just done an amazing book from it. And if you want to have that to really deepen your knowledge on climate change, I would really encourage you to read it. It's not an easy book to read, but I think you can have your views on it. To me, those are the 2, or some of those themes are the 2 most important books to read to be a good investor.
Virginie, thank you so much.
Thank
and
you.
I'd suggest you take a nice walk out on the sea out here.
Yes.
It's lovely
It
for
looks
all that
fantastic.
said. It's lovely and you'll get a good sense of the nice stuff that we have out here. Thank you
Yes.
so much.
Thank you.